Hello traders, Gary Wagner here just after 10 o'clock in Honolulu, 4 o'clock in New York. It is Friday, happy Aloha Friday as we say on the islands, 14th day of August 2015, and this is the daily report for gold and silver, our weekend review. Now that this week has come to a close, we can categorically state that for the first time in approximately 7 weeks, we've actually had this market close higher than it opened on Monday. Now, in other market circumstances, that might not be such a great deal, but considering that this is the first higher close in 7 weeks, as we move from approximately 1,200 on week one of these consecutive down weeks, all the way down to a low just below 1080, 1071, I believe was the low itself. We then had 2 weeks of inside trading in which the close was inside this last dramatic fall. And now this week we've absolutely got a rise when you consider that this market opened roughly at, call it 1085, 1086, and has closed at around 1113 on the week, that being right here. So we've had a substantial week in that we've broken this long downward cycle and actually moved up. One pattern that we can identify on a weekly chart would be a three-river morning star. Of course, this would be one with a double star, and it would, of course, also be a variation because you do have these small bodies, at least this one gapped at but not below the prior candle, and this in a harami position, which is in essence an inside trading day. Now, in terms of close on the week, of course, COMEX has closed. It looks as though it's closed off about $1 on the day, 114.50. When we look at Forex or spot, that's still actively trading, will close in just a little bit, but up about 60 cents at 115.21. Most importantly, though, the main factors, I believe, that drove this market to the upside, which was currency intervention by the Central Bank of China, is not a scenario that we really have a good sense or feel for whether or not that will continue next week or throughout the remainder of this month, or if it was a one and done, so to speak. In other words, a couple of rounds of devaluing it. Realize the devaluation that occurred this week was roughly in the 2.5% area. When you consider the euro devalued by 10%, you can see that in the grand scheme of things, so to speak, you could certainly see more of that in the near future. The reason I bring that up is because if that is one of our primary reasons that we have seen gold really take off, whether or not those actions will continue is an important piece of knowledge to have a sense or a feel for, because I really think that that is highly related to the move that we saw. Now, in terms of the technical aspects of the market, we want to look for where basic support and resistance currently lies. And to do that, I've pulled up a daily chart. This daily chart has a series of fib retracements, and I've just added a very, very short term, which is this chart here, which is basically looking at this rally itself from these lows to this high, and to determine where the areas we could look for if we see weakness come into the market next week, where we can expect some sort of support to come in the market. We've also then charted some of the interim and longer term resistance areas, and as always, we look for something simply called harmonics. And for those of you who have been with me for a while, you know that I use the term harmonics in a different way than traditional fib harmonics are used. What I am talking about is simply where you have different time cycles, and in those different time cycles, you get a matching or areas in which, for example, the 38% short-term retracement is very close to this 23%, 1108, 1105. That would be a harmonic. So this area then gets a little bit extra, call it attention, because of the fact that you have two areas, two different time cycles, really revealing that same price point. So when we look at it in that way, we can see the market. This is a 1072 to this top here. I believe it was 21. Now, we had price orders to get out at 28. I believe the high might have been 25, but we had price orders to get out at 28, and it was really based upon this fib retracement here, and my sense was that if we run into some resistance, we should run into it in that area. Close but no cigar, because as you can see, it certainly didn't come close to that area, or it came close but certainly didn't hit that area, so it effectively didn't get us out on that price order. I would have been happy with that, and I would have looked to rebuy next week. However, as this market comes down, we have a loose stop in the market. You can consider raising it, but here's the deal. To make sense out of this, you've got to really put this stop just below this area at around 1105 to 1108. That is our entry point. Call it roughly 1104 is where we entered this market. So that it's still a very, very tight trading range. If you want to protect your equity, you can move your stop up, and you'd want to move it up to maybe 1102, 1103 in that area. But this is the area that we need to see on a technical basis the market hold as support. And then really what we're looking at is a rally, a brief correction to that area, and then a continuation or a third wave up in terms of this current rally. This week's rally has certainly been event driven, and depending on what we see China do next week and throughout the month, I believe will determine the next steps in terms of gold prices. So my recommendation is as follows. Obviously, maintain your current long position in gold. 1104.50 is roughly your entry price. Stops are currently sitting at 1089, and my recommendation is to tighten them to 1102. And that, of course, is based on that band that we talked about, where we should see the market hold. It should give us a little bit of buffer room. Most importantly, it protects the majority of our equity. If, in fact, the market should come down hard next week and hit that stop, it takes us out roughly with a push or a loss of $1 or $2. If the market simply goes to the point that we talked about, that zone at around 1105 or so, and then begins to move up, we do have an OCO, which gets us out at 1128. And for the better part of the beginning of the week, let's see how the market reacts. But you can keep that OCO, the one cancels the other, in the market and maintain long position. Just remember to tighten or move your stop higher. So traders, lastly, I do want to touch upon silver. Silver, of course, is the kind of market with a decrease in volume. It has an increase in volatility. You'll typically see it as a percentage gainers if both gold and silver are moving in tandem to the upside, and percentage drawdowns in terms of a sell-off or corrective action in the market. That's just what we're seeing today, whereas gold, in essence, closed unchanged to up a little bit. We have silver closing off by over 1% on the day, down about 18 cents at 15.22. Now, we made a recommendation. We entered that market at roughly 15.26, so a few cents higher than this. Our stop is currently sitting at 14.95. Because of where the market is, my suggestion is to maintain that stop, which is sitting right in this area here. You don't really want to tighten that stop up because you get a lot of wild swings in the market. And so for the time being, maintain your current long position in silver, maintain your stop in silver. This has been Gary Wagner, wishing you as always good trading. Talk to you on Monday for another daily update and review. Bye-bye.